Friends, in this video for ITHOUGHTWEALTH, I am going to talk to you on the topic, are the high PE ratios sustainable? It's been a very long time since we have seen lower PE ratios in quality companies. If a company is of a reasonable quality, a high PE ratio is almost a given. With the exception of a few companies where the PE ratios are low because the company is not growing at all, nor is the company doing anything to add value to shareholders. Most well-run companies with modest growth have seen their PE ratios expand tremendously in the post-COVID wave. While we had a COVID wave all around us, the stock market has seen a post-COVID wave. This wave translated into a strong rally and across the board rise in PE ratios of quality companies. What happened as a result of this is most people almost reached a consensus opinion that PE ratios are never going to fall again. So when a company went to 100 plus PE, what the market started saying is, who will sell? If nobody sells, how will the PE ratio go down? The secondary observation from the market was that, there are still so many people waiting to buy these companies. These companies are in the indices, so they have no alternative but to buy. So they'll buy at any price. This is how the buy at any price investing or the BAP investing got its justification. But inflation has definitely caused a sea change in the thinking of investors. Today, at least a significant section of investors believe that these PE ratios may probably not sustain. The best case may be that the stock prices will remain stable while earnings keep growing, and stock prices could see a significant time correction even as they see an earnings expansion. Effectively, what the markets now expect is that quality companies will see PE ratios going down and probably not lose too much in valuation. But that does not apply to all companies. There could be companies which profited tremendously from COVID, which did much better in the post-COVID era than they did even in the pre-COVID era, and which got to be owned by institutional investors to the extent that floating stock almost vanished. Now, these companies may take a little while to go into a lower valuation zone, but companies where trading of stocks is high, where the stock is very liquid, will see PE ratios go down much faster than we imagine or expect. So in our anticipation, we may be erring in concluding that once a stock price goes up and once its valuation expands tremendously, it's not going back to where it was earlier anytime soon. The markets tend to think that this is the new normal, but if you take cues from other parts of the world where inflation is causing a rise in interest rates, lowering of liquidity in the system, and fall in purchasing power of a good section of society, their PE ratios have actually begun to derate. They've started coming down. So for a small disappointment in sales and a modest disappointment in profit growth, companies are getting excessively punished. This would mean that PE ratios will come down. If you look at the American companies, the FANG stocks have significantly fallen and the PEs have almost gone to the pre-COVID level now. This means that we could see valuations go even lower than the pre-COVID level, and the markets will have to show confidence in these companies. If this is the fate of FANG companies and the best of blue chips in the US, what is it that awaits Indian blue chip companies in the large cap space, in the mid cap space, in the small cap space, and in the micro cap space. So each space runs the same risk, and the magnitude of impact on each space could be very different, because selling a very liquid stock is far more easy than selling an illiquid stock. So a large cap company may be extremely liquid, but a micro cap company may be extremely illiquid. So investors must understand that selling is not going to be easy in the coming phase, and those who want to sell will anyway sell. These two aspects will lead to a derating of companies. PE ratios will come down, but the time it would do it would always depend on how liquidity in the stock trading is maintained. If the stock becomes more illiquid, then its fluctuation will become higher. So keep a close watch on companies where valuations are very high. If possible, book out some profits and stay liquid, or at least stay away from overvalued companies, and choose companies very, very carefully based on the future PE, because we are definitely seeing PE ratios run down once companies raise money. That is why most of the listed companies which raised money in the last 1 year are trading below their issue price. They were priced very aggressively. But the same thing could happen even to smaller companies. In smaller companies, the problem is a little complex. A few companies raise capital. Not all companies have recapitalized themselves. They didn't do QIPs. But the PE ratios expanded beyond what they usually do for companies of that size. So you saw in small and micro cap companies PE ratios that we have very rarely seen before. So some companies took advantage of it and raised money. Most companies did not, but all companies tend to be punished. But the companies which raised money may be punished more, because those who have bought at a high rate may sell once the price falls below the issue price and starts going down further. They don't want to take the pain of losses, and they definitely don't want to wait for their price to come back again. So they'd rather take that company out of their portfolio and put something else in which has a better chance from here. So selling is going to gain momentum across the board where PE ratios are still high. It just needs one smart seller to crash the price, and then all the others who are waiting may actually jump on and still sell even though the prices have fallen. We are seeing that in the developed markets. We are seeing that also in the Indian market in pharma companies. This will spread to wherever PE ratios are high. So before you come to that blindsided confusion that PE ratios cannot go down, please take a look at what is happening in the Western world. Take a look at what is happening even in the overvalued, super high PE consumption companies in India. See how much they have fallen from the recent highs, and you'll know something is happening. What I would like to point out here is that what is happening now may actually gain more momentum, and you will see that momentum hurt on the downside. So the conclusion that high PE cannot go down is probably a rushed one. It's most likely to be flawed, and it's going to break the hearts of a lot of people who don't expect valuations to come down. A flawed conclusion can hurt an investor a lot more than he thinks, and it could create a sense of anger, disinterest, disappointment, and desperation in investors, especially when stock price continues to fall. So, as an investor, you should prepare yourself for a contraction in PE ratios, even in the most high quality companies. It just needs early birds to sell aggressively, and it will leave a whole lot of people with FOMO and a sense of anxiety to sell. So we may see no anxiety today, but this could be replaced by a phase of high anxiety tomorrow. So that is one thing that you should be very, very aware of. You should expect the worst so that when it happens, you are well prepared and you're not going to become a person who is unable to respond to a disappointing situation. So anticipate, prepare, move to safety and make your journey a more pleasant investment experience in the days to come. It's quite certain that PE ratios will gradually move down. In some parts, it will move aggressively or actively. Either ways, you must be prepared for lower valuations in the Indian stock market, and you must be ensuring that your portfolio is prepared for that scenario so that you're ready to either buy when valuations fall or you're not caught owning super expensive stocks when they fall. Thank you for watching this video.